Hey everyone, this is Kirk here again at Option Alpha. Wanted to take a look at some of the trades that we made this week on tonight's video and kind of go over some of the terminology that we're using now with these new SMS trading alerts. So I've gotten a ton of feedback. Everybody loves the fact that these are coming out so quickly and so timely. So we're going to continue to work through some of these issues that we're having with some of the international people. So bear with us. We're trying to get a couple different services on board to help with new international numbers in some countries that typically don't have as great SMS service. So that's one of the things we're dealing with. But all U.S. Canadian customers should be okay right now with U.S. numbers. But I want to go over some of the trading alerts that we sent out over the last couple days and some of the closed positions and really kind of go through in this video why we made some of these trades, what was the thinking behind some of the trades that we made, and then also show you exactly what the alerts look like so we can talk through them together. So first I want to go over a chart of the US indexes, the SPY right now. Obviously had a phenomenal last 2 weeks. We've just continued to move leaps and bounds forward since really the beginning talks of the ending of the government shutdown and debt negotiations. So I think right now the fact that we've been up 6 out of the last 7 trading days really tells us that we were going to have a couple days here where there's going to be some profit taking for sure. So that's why we started to close out some of the positions that we had this week, especially in some of the volatility indexes and some of the bigger tech names, which I'll go over here in a second. So let's get into some of these trades, and I'll do a combination of both showing some of the trades as well as showing the charts that go with them. So let me just bring up some of these right now for you guys. Okay, so here's my desktop and have a couple different orders open for you guys, and I want to kind of go through these together. So the first trade that we made is right here on the VXX, and this is the actual SMS alert that goes out. So you can see I send it to my service here that automatically sends it to you guys, but here's the actual alert. We bought to open. So this was an opening trade, and in this particular instance, we bought 3 vertical spreads on the VXX. The 100 here means that each contract for VXX controls 100 shares of VXX. So it doesn't mean that we bought 100 contracts by any means, but we bought just 3 verticals. In this case, they were the November 13 expiration contracts, so they were expiring next month, and we bought the 16-14 put spread for $1.05. So what that means here is that we bought the 16 and sold the 14 to help finance the purchase of the 16 puts. That combination means that we had a $2 wide spread and that we were buying it for $1.05 per spread. So in total, it cost us a little over $300 for the trade. Now that was on October 7th in the afternoon, right before the close of the day. And then you can see here that we actually sold that and had that closing alert go out to everyone on October 17th. So just about 10 days later, we again have a closing order. We sold the 3 that we had bought on VXX. You can see the same November 13 contracts, the 16-14 put spread, and we sold it for $1.68. Now remember that this is only $2 wide. So the most we could make on this trade would be $1. And so that it would be trading at exactly $2 per spread. So in this case, we made more than 50% of our profit target in about 10 days. So there was no point in letting this thing continue on through expiration. And since we were buying a put spread versus selling some put spreads to begin with, then we needed to take advantage of what the market had given us already. So now let's go to the chart real quick and talk about where that trade actually happened. So again, you can see this is a chart of the VXX that I've thrown up here. This is the 8th, I believe, or 7th when we bought these. So we bought these right around here, the 7th. And you can see that the VXX was just running really, really high at that point. And that, again, was right before all of this talk with the debt ceiling ending and the government shutdown ending. It was kind of heading into that weekend. So we bought these assuming that at some point volatility would contract back down lower. And so that's what we were hoping on. Now we sold them on the 17th, which was just this day here, this big red day. So again, you can see we had a huge move back down in the market, and that's when we took our profits. Again, there's no point to let this thing ride out through another 30 days of market cyclicality where the market could continue to go back up and more volatility. So we want to take our profits off the table. Okay, let's talk about another trade that we made. So the other trade that we made here, and let me just close these out real quick so we don't get confused. The other trade that we made here is on Netflix. So again, with the market being so volatile back around the beginning part of October, we decided to sell a vertical put spread for a credit. So in this case, this is a little bit different. We actually sold to open -1 contracts. So what that means is that we're really short the contract. And I think a lot of people are a little confused on this, but you can actually sell options to open instead of opening a trade with a buy order. So in this case, we opened with a sell order and we're short one vertical Netflix. Again, the 100 is just saying that each contract controls 100 shares of Netflix. The November 13 options, and again, we sold the 260 put and bought the 255 put. The total credit between what we sold and what we bought, we took in a credit of 152. Now in this case, the puts are about $5 wide. The strikes are $5 wide. So our max risk before our credit is $500. Since we took in a credit of about 150, that means we have about 350 in potential loss. But in this case, we sold this put spread well below the market. So that was our hope, that the market would go up. Volatility was so high at that time that these were trading at a premium, and we thought that they would go down in value. So again, the reason that we wanted to sell these is we want to sell them high, take in the credit, and that hopefully they go down in value. Okay, so fast forward a couple days. So we sold these on the 9th. Back to the 17th, we sent out a alert to all of our members, closing order. We bought these back, so we bought one back. Again, we were short one vertical spread, so we bought that vertical spread back to close the loop. The Netflix 100 no 13s, 260, 255 puts, and we bought these back for 52 cents. So we made $100 on the trade. Not a bad trade if you ask me. It's just a quick trade for a couple days. Again, these can only go to zero. We want them to be worthless. So at this point, we've made $100. We've made more than 50% of what we could potentially make on this trade in about 10 days. So for me, the risk was not in letting this trade go to expiration. Could it possibly go down another $52? Sure. But at that point, we're still leaving on risk about $350 in the market. So I didn't want to leave that risk on. I felt it was prudent to take that money off the table and look for other trades. But moreover, when I show you the chart here, as I'm going to pull up right now, on Netflix, when we made this trade, volatility contracted substantially. And we also have earnings coming up. So those two things always make me a little bit concerned about where earnings may go. So I decided close out the trade right now. We made some great money on the trade. And since volatility contracted, that's really what we were looking for anyway. So as I zoom in here a little bit more on the chart of Netflix, this bottom section here is implied volatility for Netflix. So you can see this green line had been continuing to run up, meaning implied volatility was very high and that the options were getting more and more expensive. So right here on this red day was a big down day for Netflix, October the 9th, and that's when we sold these options. And you can see that implied volatility was pretty high. It was actually about as high as it's been in the last 6 months. And so we waited a couple days, and as the market moved away, which absolutely helped, volatility also contract. And that's what helped bring down this premium so quickly so that we could make money. And again, you can see that we sold it here on the 17th, taking in a nice $1 profit. So that's really what we look for in these types of credit spread trades. When you're looking for credit spreads, it doesn't matter which side of the market you go on. You could have easily sold a call spread, but in this case, I had just an assumption that the market would move higher at some point as these debt negotiations started to come to a close. So as the market moved higher, volatility contracted. You could have easily sold a call spread way above the market, and although the market moving against you wouldn't hurt or wouldn't help, the volatility contraction could definitely help your position, and you possibly could have made a nice little profit here as well. Probably not as big of a profit as we made on this one, but you definitely could have made a profit with volatility contracting. Okay, so let's look at just one more trade that we made. Again, we made a ton of trades over this last 2 weeks, and I just wanted to bring out a couple that just show the different types of trades that we're making here and just help everyone with the terminology. Okay, so now this isn't a vertical of any kind. We're not buying a vertical. We're not selling a vertical. This was just a pure volatility play that we made on the VIX. So again, back on October 8th, same time frame, everything was kind of going crazy. We bought to open 3 VIX November contracts, so same ones we've been dealing with, the 15 strike puts for $55 a piece. So in this case, we are purely buying a single option. Now, I would usually never do this. I only only ever buy these single options when I'm buying options, usually on the VIX. It's usually the best choice for buying single put options. Anything else I'll usually do a spread or calendar or diagonalize, but on the VIX, I feel very comfortable doing any type of single option buying because I think you get a better bang for your buck. So in this case, we just bought 3 VIX November 15 strike puts for $55. Now on the 17th, as the market continued to cool, volatility dropped, which helped our position because we were had the put spreads that were, or the puts that were long. So in this case, we sent out an alert that was closing the 3 that we had bought before, November 13, 15 strike puts, and we sold them for $1.20. So we made more than 100% on our investment, doubled it in a couple days. Again, at this point, you take money off the table, especially when you are net long options and the market gives you a great move. You take money off the table. You don't wait until November and try to gain every little ounce out of the trade. Take money off, lock in your profits, and move on to the next trade. So again, we go back to the charts here, taking a look at the VIX. The VIX on the 8th, when we sold these, was practically at its highest point, and the VIX hadn't been up there for a very, very long time, just going back a couple months. The last time the VIX was up in this 20 range was back in June and July of this summer. So the fact that it was up here, I felt very confident in saying, okay, you know what, let's take a shot in the dark here and see if we can't make some money on a volatility contraction. And that's exactly what we did. So the VIX was up here around 20. We bought the 15s, which was a pretty low or pretty out of the money put that we bought. You can see it wasn't very close to the money at all. Definitely wasn't in the money. We were kind of trading these on like kind of almost a long shot here. And that's what we did is made money as the market and volatility contracted. We sold these out on the 17th just as the VIX was moving under 15. So as soon as this option went in the money, it's a good trade for us. We got some good premium for it and closed out the trade. So hopefully this video has been really helpful for you guys as far as understanding what we kind of look for in trades. Again, the biggest thing right now that I see a lot of traders doing and a lot of coaching that I'm doing is that people are not selling volatility. They're actually looking at these charts down here and they just kind of make a guess on where volatility is. The biggest advice I could give you is take a look at this implied volatility chart for all of the options that you're trading. So I'll just throw up another chart here of Facebook. Facebook has incredibly high implied volatility right now. Look at how high implied volatility is. So even though earnings are coming up, which you should definitely be on the lookout for, right now all kinds of put spreads and verticals and strangles in Facebook should pay a pretty good premium once volatility starts to contract. So if anything, you don't want to be selling these verticals and strangles and iron condors when volatility is at pretty much the lows. That would be a very bad decision because you're selling expensive premium when premium is actually really low. So what you want to look for is you want to look for these high implied volatility levels on anything that you're trading. And that's when you want to start selling call spreads and strangles and iron condors. Anything that's lower, probably not a good trade at this point. So hopefully this has, again, really been a helpful video for you guys going over some of these trading alerts. As always, if you have any questions, comments about what we went over, please add them to the comment section right below here. And as always, happy trading.